All right, let's jump right into a really fascinating story. We're talking about a company that's sitting right at the epicenter of India's massive energy revolution, Siemens Energy India. It's a story about a huge opportunity, incredible financial strength, and one very big question mark. Let's get into it. So let's kick things off with a number, a huge one, 9.15 trillion rupees. I mean, just try to wrap your head around that. That's how much money is expected to be spent just upgrading and expanding India's power grid over the next 10 years. We're talking about one of the biggest infrastructure projects on the entire planet. And this leads us to the heart of the matter. See, there's this one company that seems like it was custom built from the ground up to grab a massive piece of that 9.15 trillion rupee pie. But as you'll see, perfection, well, it comes at a steep price. So is Siemens Energy India a golden opportunity, or is it just way too expensive to touch? That's what we're here to figure out. Okay, so to really get a handle on the opportunity here, we first have to understand where this company even came from. It's a pretty recent development, but it's absolutely crucial to the whole story. The whole thing started with what's called a demerger. Back on June 19th, 2025, Siemens Energy India was officially spun off from its big parent company, Siemens Limited. The best way to think about it? It's like the star guitarist of a famous band leaving to start their own new supergroup. They basically took the entire energy division and turned it into its own independent, laser-focused company. And look, this wasn't just some boring corporate paperwork shuffle. It was a genius move. Suddenly, the energy business had its own management team that lived and breathed nothing but energy. It meant they could pour money into huge, long-term projects way more efficiently. And for investors, well, it created this perfectly clear way to invest directly in India's energy transition, what the pros call a pure-play company. And that brings us to the really big picture. This company didn't just pop up out of nowhere. It was basically born right into the middle of what people are calling India's power supercycle. The timing couldn't have been better. You've got these three massive currents pushing Siemens Energy forward. First, there's India's insane push to get 500 gigawatts of renewable energy online. Second, the grid itself is old and desperately needs to be modernized to handle all that new green power. And third, you've got the explosive growth of new energy-guzzling things like data centers and the whole green hydrogen economy. It is a true perfect storm of demand. But here's the catch, right? You can build thousands of solar panels out in the deserts of Rajasthan, which is great, but the factories and homes that need that power are in places like Mumbai. And obviously, solar doesn't work at night. This creates a gigantic bottleneck. You need a modern, high-tech superhighway to move all that electricity from where it's made to where it's needed, whenever it's needed. And this is exactly where Siemens Energy's superpower comes in. The solution is a technology called HVDC. Now, the total market for this stuff is a mind-boggling 1.2 lakh crore rupees, but Siemens has a special advantage, a tech moat. They're experts in a more advanced version of it called VSC, which is absolutely essential for keeping a grid stable when you have tons of renewables. So their own specific target market is still a massive 30,000 crore rupees. Okay, so the opportunity is huge. We get that. But the big question is, can the company actually deliver? Well, let's pop the hood and look at the financials, because what you find is nothing short of a fortress. Let's start with this. 47%. That's the growth in the company's order book, year over year. Now, this isn't some analyst's guess about the future. This is a backlog of actual signed, confirmed work. It gives them an incredible, clear view of the money they have coming in for the next couple of years. Okay, now for what might be the most impressive number of all, 0. That's the company's net debt. 0. Zilch. In an industry that eats up massive amounts of cash for these giant projects, being totally debt-free? That's almost unheard of. It puts them in a position of incredible power. And if you thought that was good, it gets even crazier. They run the business with something called negative working capital. Let me break that down. It means their customers pay them huge amounts of money up front, long before they have to pay their own suppliers. It shows you just how much bargaining power they have. They are literally using other people's money to fund their growth. It's an incredible position to be in. So what does all this amazing financial discipline add up to? It adds up to this, a return on capital employed of 38.5%. In simple terms, this number tells you how good a company is at turning money into more money. And let me tell you, 38.5% is an absolutely elite number. They are masters at generating profits.
So let's recap. We've got a perfect company in a perfect market with pretty much perfect financials. It sounds too good to be true, doesn't it? Well, this is where the story takes a sharp turn, and we run right into the big conflict at the center of this whole thing.
111. At its peak, the stock was trading at 111 times its annual earnings. That's its PE ratio. To put it simply, that is a very, very high price. Think of it like buying a Formula One car. You're not just paying for the metal and the engine it has today. You're paying a huge premium for all the races everyone expects it to win for years to come. But you can't just look at a number like that in a vacuum. You've got to see how it stacks up. When we put it next to its competitors, things get interesting. Yeah, its PE of around 85 is high, but its main rival, Hitachi Energy, is even more expensive, at 115 times earnings. Now look over at that other column, return on equity. At 29%, Siemens is way more profitable. It delivers way more bang for the buck than Hitachi. And this is what it all boils down to. This is the core debate. On one side, you have people saying, look, this is a once-in-a-generation growth story. Of course you're going to have to pay a premium for the best company in the game. But on the other side, people are saying, whoa, that price is so high, it's priced for perfection. It means if they make one tiny mistake, lose one big contract, the stock could get hammered. There's just no room for error. So with this gigantic opportunity on one hand, and this sky-high price tag on the other, where do the experts who study this stuff for a living actually land? What's the final verdict from all the data? Well, the consensus recommendation you see is accumulate on dips. So what on earth does that actually mean? It's basically the analyst's way of saying, we absolutely believe in the long-term story, but man, that stock price is high and it's going to be a bumpy ride. So they're advising investors to be patient, wait for the stock to have its inevitable bad days, the dips, and use those moments to build a position for the long haul. And of course, we have to be clear-eyed about the risks. The biggest one, the market could just fall out of love with expensive, high-growth stocks, and that high PE multiple could shrink. Second, when your business is built on winning huge projects, losing just one of them to a competitor can really hurt. And finally, you always have to worry about the price of raw materials like copper and steel going up and eating into your profits. So that leaves us with one final big question to think about. You've got a world-class company sitting in the perfect spot during a historic energy boom. Its financial health is nearly flawless. The only catch is that price tag. And so the question you really have to ask yourself is this. In a once-in-a-generation opportunity, is a high price a warning sign telling you to stay away? Or is it just the cost of admission?